into Imagica from day one. Usually parks, to make 4 different parks at this scale will, take a good amount of time. So for Imagica, it's a beneficial deal because at a good price, the cash flows, there's no risk of execution at that point in time. These are parks with historic performances and proven EBITDA. So adding those into Imagica will, give more cash flow to Imagica itself.
Okay, fair enough, sir. And this Shirdi Water Park which we have acquired is like matured park now. So how we are going to drive the growth in footfalls there? Also, can you share how much footfall growth and average revenue per user growth do you expect in FY25 in overall terms, including the indoor park?
So for Shirdi Water Park, as you rightly said, we have spent 25 crores in this current financial year, adding new attractions and rides across all our parks. So in Shirdi Water Park, we have added 8 new water slides to revamp the park and, kind of give our guests a new reason to come back to the park. So with 8 new water slides, we are seeing increasing in capacity of the park as well as repeat footfall should go up significantly over there. So we see some good growth in that particular park. Along with that, we have also added a lot of retail which will start from 1st of April and a lot of new F&B options. So our ARPUs are expected to go up with these new additions as well.
And how much footfall the indoor park will be adding in FY25? A ballpark figure can you give?
I think it will be a better thing to say FY26 because by that time the park would have really seen the full year of operations. So we think somewhere around 3.5 lakh, around that number is what we expect in the first year of full operations.
All right, sir. And just a suggestion to keep watch on the equity dilution happening for investors. And that's it. All right. Thank you very much and all the best. It's actually a proud feeling for us that such a new big group is emerging from small towns, of the country. So thank you very much and all the best.
Thank you. Thank you, sir.
Thank you. Next question is from the line of Anant Mundra from My Temple Capital Advisors. Please go ahead.
Hello. Good afternoon, sir. Thank you for the opportunity. Sir, I just wanted to understand what is the nature of the underlying land in the 4 operating projects that we are acquiring? Is it a leasehold land or is it a freehold land?
So these are all freehold lands. We have about 48 acres in Lonavala and about 13 acres in the heart of Shirdi for the Sai Tirth and the Wet Enjoy parks in Shirdi. Totaling 61 acres is what we get of freehold land.
Okay, they don't have any kind of lease from the state government, so we don't pay any lease rentals or anything of that sort of thing, right?
No, definitely not.
Okay. That's it. Thank you.
Thank you. Next question is from the line of Rajan Shinde from Mehta Equities Limited. Please go ahead.
Thank you for the opportunity. How about the pipeline inorganic growth strategies with planned any and how would it be funded?
Rajan, sorry, your audio is not clear. Can you speak a little louder, please?
Now it's audible?
Yeah.
Yeah. How about the pipeline inorganic growth strategies? If they have planned anything and how will be funded, sir?
So for inorganic acquisitions in the future, if there are parks which are open for acquisitions, we are always on the lookout. And in case some good parks which fit our quality standards and our quality standards, we are open to those acquisitions. And it can be funded through a mix of debt and equity. We can fund these parks in the near future.
Okay, thank you. Sir, what the current consolidated debt on the books post acquisition will be, sir?
At the point of acquisition, we currently do not have any debt. But yes, to make the committed payments, we've mentioned that we could leverage to around 2.5x of EBITDA of the combined entities.
So the total debt would be, sir, then?
At the combined level, if we add up both EBITDAs of this entity, so combined debt, could be in the range of 350 to 400 crores. and remaining would be funded from the internal accruals of these parks.
Okay. Thank you, sir. Sir, there's a news of developing Lonavala hill points like Tiger Points. Is Imagica participating in these projects also?
No, not to our knowledge. But yeah, since you mentioned, we'll just check out on this. But yeah, Imagica is not associated with it, and at Malpani Group also, we just have no involvement in this. But we'll definitely check out if there's such development.
Okay. Thank you, sir. Sir, regarding the acquisition, its total the acquisition would be paid, as you told earlier, in the span of nearly 30 months, right? So will how the Imagica will generate such profits and pay off to the seller? Can you put some light on that, sir?
Yeah. So as you would reckon that from 1st April 2024 itself, we not only be able to utilize the EBITDA and the cash in hand of Imagica listed company, but the revenues and the EBITDA of the acquired park also, the proceeds are part of the listed company. So we think that over the period of 30 months that we have the agreed tranches of payments, there will be utilization of these free cash flows that we generate. And as you would notice that for the new acquired parks, the EBITDA that we generate is almost the free cash flows to the company in terms of accruals. So we should be able to be comfortable as far as the payouts are concerned, as well as the company would be availing the limits from the lending banks. However, we will utilize based on judicious discretion to ensure that we do not, while the limits are required, we may not want to utilize to the fullest that we would be. That would be our strategy and approach. However, like the question that was there earlier, if there are any inorganic or any other such arrangements that we get, we would be open to that as well. And the point that you may want to note that there are no taxes payable, since the company also has the carry forward losses that the company can utilize as tax shield. So free cash flow benefit out of EBITDA is what we think would really help us tide this over the entire transaction well. I hope I have answered your query.
Yes, sir. Thank you very much. Sir, one last question, sir. Can you put some light how the Imagica will totally looks like after the acquisition in simple?
So your company would be almost, you can say, one of the largest listed company in this entertainment space, with revenues upward of 400 odd crores, with the EBITDA almost touching about 200 kind of crore EBITDA. So a healthy 48 to 50% kind of EBITDA margins with few more projects in the annual. So I think it will be something. You can say almost among the top 2 companies that you would see in the space of this category.
Okay, sir. Thank you. That's from my side. Thank you very much.
Thank you. Next question is from the line of Binoy from Sunidhi Securities and Finance. Please go ahead.
Yes, sir. Thank you for the opportunity. So first question is the consideration of 770 crores. Is it entirely to be paid in equal installments, or is there any front ending of the same or back ending of the same, anything like that?
So thanks, Binoy, for your query. We've uploaded the investor presentation a couple of days back, so I think that will have the schedule of payment. So 140 crores of the Indore is kind of upfront payment, but the 630 crores of consideration for the existing parks is staggered over the 30-month period, and we put the actual schedule up on the presentation. So it's at the sign up we only to pay 30 crores, and within the quarter we have to pay additional 100 crores. For the remaining payments is staggered into tranches of 100 crores every 6 months. So the schedule is put up on the presentation for your consumption.
Sure. Thank you so much. And the second question was, do we see any cost synergies from eliminating duplication of resources after this acquisition?
So, Vinay, we see a lot of good cost synergies coming into play. First of all, our senior team, we'll have a common senior team across parks that would lead to good 10 to 15% of cost synergies on that front. Along with that, our back of the house operations like, purchasing, HR, accounts, finance, sales, we are consolidating into one location, which will work for all the parks, so that operating leverage, which has to come into play for all the parks, that will come into play as well. And our procurement will go up because, when we are negotiating for so many parks at the same time, over there we'll see roughly up to 15% of cost saving. And then for agent payout, transaction costs, since we are operating 7 to 8 different parks at the same time, we'll see again some good cost synergies on that front. Along with that, since we are operating in the same location in Maharashtra for the 4 parks, we can have things like common passes or a super pass where customer can visit different parks at the same time or in the full year. So these would lead to a lot of repeat visitation across all our parks, and we can cross-sell and upsell to the guests based on this.
Thanks for that elaborate answer there. Is there any number that you can share in terms of the total cost savings as well as the revenue synergies by cross-selling, upselling?
At this juncture, we don't want to quantify this number, but yes, we are on the various heads that we mentioned, right from advertising, right from manpower, and various other synergies. I think in the coming quarters, we'll have a better sense of those numbers which we can share with you.
Fair enough. Now, the last question is on the indoor water park that will be coming up. You said that you expect after first full year of operations, footfalls of roughly about 3.5 lakhs. What is the ARPU that you are targeting in this park? Will it be very similar to what is Wet n Joy's ARPU, or will it be lower?
So the ARPUs will be in the range of 900 to 1,000 rupees to begin with. So that is what we are targeting. And just to add to that, our indoor park has a capital subsidy of 30%, which Imagicaa will avail. So that 140 will eventually come down by roughly 30% on fixed assets. So that number we are likely to see go down in the next coming 3 to 4 years.
And this subsidy will flow in over what period of time?
It will flow over a period of 4 years. 3 to 4 years.
Understood. Thank you so much. That's all from my side.
Thank you. Next question is from the line of Faisal Hawa from Imagicaaworld and Company. Please go ahead.
What will be ROC and ROE of the combined entity going forward? And is it not possible that the company could actually do these 100 crores payments from EBITDA itself, by really being very tight on finances and being very cost conscious? And second point is on the strategy front. See, Imagicaa and Wet n Joy are like two very separate brands. Imagicaa is very much like a international quality theme park, whose rides are almost on par with Disneyland, and Wet n Joy is much more towards the masses. So having managed a product which is more towards the masses, how will we really have the wherewithal to manage a very niche and an upper class product? So because these are two very different markets, even though it is within the theme parks segment. And secondly, sir, what is the bigger vision of the company? Do we want to be at at least 25 to 30 cities in the next 10 years? And the promoters could have actually merged the company and probably raised their holding also, but they have decided to take the cash out of it. So what is the rationale behind that?
So there are multiple questions. Yeah. So we'll take it, I'll not go sequentially. Yeah. I'll answer your last question first. The promoter holding currently stands, on a fully diluted basis at 74.5%, so nearly at 75%. So a share swap wasn't the structure that was feasible at this juncture, else we would have preferred for that. Hence the cash consideration. However, it is deferred, unlike any other acquisition which you will see. You're getting the business upfront, but yes, you've got 30 months to pay. So the present value actually is much lower than what would come out. Second part is in terms of managing these different segments, just to advise the operating teams remaining the same, they are already, positioning and selling those respective parks at various levels. And we don't foresee any constraints, because the entity now is being combined. Whatever is being done in terms of the sales force at the ground level, Dimant, you may want to add.
Yeah. So, as it was mentioned earlier, there are a couple of new attractions which are being introduced in Wet n Joy Lonavala Amusement Park, and the new introductions are something really worth waiting for, because they are kind of state-of-the-art attractions that are being added, and that becomes a part of this entire investment and inventory that we will be able to get. Secondly, if you will see that Wet n Joy Amusement Park opened just prior to COVID, therefore it had not really seen a proper full year of operations, and based on various feedbacks that were received from the guests, as well as certain new introductions which were in the pipeline, that all is getting commissioned in this year. So you will see that FY25 full year of operations will actually be able to enjoy the complete efforts and investments that were being made by the group as a full year of operation now. Secondly, it is really not a mass park in terms of the original design. However, as it was in pipeline in terms of completion, what you will see now is a very different experience, and something that would be nice from a guest experience and the quality point of view also. So especially
sorry to interrupt, but are we trying to say that now Wet n Joy will be a very upmarket product? And
no, I would not say very upmarket, but yes, it will be from what you would have seen, it will go at least 2 to 3 notches above. Yeah.
Okay. So we are now aiming for a different income group only.
Yes, and what it would also do is that, as I was explaining, sir, since it was in development in the pipeline that were being initiated, this is the full year of operation that you are going to see. So whatever that we've seen of Wet n Joy Amusement Park, it is going to get better from here. Yeah.
In terms of
the other questions also.
Yeah. So in terms of the returns, for any inorganic acquisition or any expansions, we are looking at IRRs in the range of 18 to 20%. And because of the high capital base high asset base of Imagica, the return on capital employed and all will take some time to make sense. On the overall vision you mentioned for going into other parts of India, I think Jay, if you could just throw some light on the question that he mentioned about multiple cities that we are looking forward.
So sir, our vision is to go across India in all the tier 1 and premium tier 2 cities across India, and we are evaluating various different options with state governments. We are evaluating options with in the NCR region, Gujarat, Goa, Punjab, Tamil Nadu. So we are in talks with various different governments at this stage. So the vision is to go across all different tier 1 cities and selected tier 2 cities. And with the current acquisition being done, we have a bouquet of offerings now. We have a devotional theme park, we have a theme park, we have an amusement park, we have a water park. So based on the demographics, the city and the location, we can play around with various different offerings since we have the learning curve and experience operating all these things. So it will be a good advantage for us to kind of have a good mix and match of these formats based on the location.
Thank you. Faisal, do you have any follow-up question?
Do we have the time for it?
So I'll request to come back for a follow-up.
I'll do that.
Thank you. A request to all the participants, please restrict to 2 questions per participant. The next follow-up question is from the line of Dhruvesh Sanghvi from Prosperity Financial. Please go ahead.
Yeah. Sir, one more part. In terms of branding, are we going to use Imagica as a title brand even for Wet n Joy, something like Imagica Wet n Joy, or any thoughts on that? And what will be the branding for the future parks?
Yeah. So we would not be using Imagica Wet n Joy kind of combined name. We will allow the brands to remain independent. For future parks, the flagship kind of parks which are larger in size and scale is where the thought is to use Imagica as a brand. And we also have 2 more brands in our portfolio, 3 more brands. So we have Imagica, we have Wet n Joy, we have Aqua Imagica, we have Saitis and Magic Mountain. So these are our portfolio of brands. So depending on the format and the size and scale and the city profile, we will be utilizing the brands selectively.
Sure. And what would be the current cash on books of Imagica?
At this point, we have 70 crores plus cash on our books.
And no debt, right? Because you've mentioned we are debt free.
Yeah, we are debt free.
Okay, fine. Thank you. Thank you, Jay.
Thank you. Next follow-up question is from the line of Rusmik Oza from 9 Ways Research. Please go ahead.
Thanks for the follow-up, sir. Sir, I wanted to understand the breakup of revenue in Imagica of the acquired assets, if possible. The question I'm asking why is because Imagica EBITDA margin is 36%, and in the presentation you're showing 57% EBITDA margin for the acquired assets. Now, within the acquired assets, in the call you mentioned that the Shirdi site park is generating 35% EBITDA margin. That means your Wet n Joy, Lonavala and Surat, is it that it's making more than 57% EBITDA margin? Just to get a granular breakup of the margins of per park, it will be helpful, sir.
Yeah. So you're right about the existing margins that is with Imagica is there. On the combined level, the 4 parks are generating 58% EBITDA margin as of FY23. And in that, obviously at the various park levels, as Jay mentioned, the amusement park at Lonavala, there is work in progress which was happening, and post the last 1 year itself, there is ramp up which is happening. So the margins at this level, we are not giving the breakup of the respective parks, but even Saitis is a new location and new attractions being added over there. But as an aggregate of FY23, these parks have been generating 58% margin, and in the trailing 12 months, this would have increased to 65%. I would just like to add, and this is the actually proof of that the capex which is done over the last 1 year or 1.5 years is helping, and these parks are clearly in a growth mode, and the base also is helping. And when you combine both of these, you can just add up the math at what Imagica is currently generating and what Wet n Joy is currently generating on a 12-month basis, plus the synergies which we are not really quantifying at this juncture. Combined, the margins will be much better than what they are today for Imagica.
Okay. So, related question, since you're operating at 57% EBITDA margin in the acquired assets and Imagica is around 36%, do you see the margins of Imagica suppression can go up to 50% plus in future? How do you see that?
At the combined level, if we just add up, it's coming down to an average of 44-45%, and we see no reason, why they could inch upwards closer to 50% in the years to come.
Okay. And second question, sir, is is there any what will be the capex requirement for Surat and Lonavala parks going forward?
So there is really no immediate capex requirement for Surat or Lonavala parks, because in both in fact almost all the parks the capex requirement have been methodically been done. So almost by this April or May of this year, you will see that all CapEx would have been completed in all current parks.
Okay.
Yeah. And that's been factored in the calculations that we've mentioned to you, by and large.
Thank you very much. Rasmik, I'll request you to come back for a follow-up question. Thank you. Next question is from the line of Jay Toshniwal from Toshniwal Equity Services. Please go ahead.
I have two questions. First question is that there is a sale of land parcel of about 100 plus crores, and the consideration of about 35% is coming by way of cash, and the balance coming by way of a deferred bond, preference share, where the money comes in after 20 years. So what is the logic for deferring the cash inflow at almost zero interest? And which is the issuing company for this preference shares? That is the first question. And second question is, what are your plans regarding devotional park expansion beyond Shirdi, say for example Ayodhya or Varanasi or Mathura, etc.?
Yeah. Thank you for your question, Jay. Yeah, answering the first question. So this is a transaction which is from the resolution of debt which happened with the lenders, and it is primarily whatever cash consideration had to be received in the books has already been received. For taxation purposes, there is this instrument which is there. So this is not, in terms of any recovery that we are expecting from that. So it's purely a tax structure which is there, and it was part of the erstwhile management deals which were concluded at the point of resolution by the Malpani Group. Coming to the second question, for devotional theme parks, especially in Ayodhya and Varanasi, Jay, would you just want to?
So Jay, we are exploring those because since we have good experience with site already in Shirdi, which is on the similar line. So based on this, we have been talking to the people at Ayodhya, Dwarka or Varanasi for that matter. So we are exploring land parcels over there. I think we are in talks, and when something gets concluded, we'll update you on the same.
Okay, thank you.
Thank you. Ladies and gentlemen, due to time constraint, we'll take that as the last question. I'll now hand the conference over to Mr. Jay Malpani for closing comments.
We appreciate your participation in our business update call today. We trust that we have addressed all your queries. Should you have any further questions, please feel free to reach out to our investor relations advisor at Strategic Growth Advisors SGA. Thank you and have a pleasant afternoon.
Thank you very much. On behalf of Imagicaaworld Entertainment Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
Thank you.